Welcome back, fellow investor. As always, I'm your host, Brian Davis, co-founder of Spark Rental, and I'm on this journey with you guys. Every month, we get together with our co-investing club members. We vet different real estate investments. We invest together, and this is my plan for financial independence too. It's my personal money in every one of these deals, and it's fun to bring in different experts, both to our co-investing club and also here on the podcast, to get different perspectives about how to invest in real estate and how real estate fits in with your broader portfolio and your broader financial goals, which is exactly why we've brought in Sean Lovison today. He's a certified financial planner. He's the founder of Purpose Built Financial Services. And Sean, I wanted to talk to you today about where real estate fits in with your broader asset allocation and how we as real estate investors should think about real estate in the context of our broader portfolio. So tell us your thoughts.
Well, thank you for having me, Brian, and I'm really happy that we met up because real estate is very important to my portfolios. I'm a big believer in David Swensen and his Yale portfolio model, and he had a very heavy allocation towards real estate in his model for some very good reasons. His base models have about 20% of real estate built into those portfolios. Now, when he was managing the Yale endowment, that was through direct real estate investments, but obviously he realized that that wasn't applicable to a lot of individual investors. So he substituted out a lot of that stuff with REITs, was his primary go-to on that. But in modern portfolio theories, you can see that that's kind of been devalued a little bit in terms of REITs having a lot of the same volatility characteristics as stocks, right? So there are better ways to go about getting that real estate, exposure in your portfolios, which is very important because real estate does have a lot of benefits in a portfolio allocation. It provides good diversification. It's an inflation hedge, an income generator, has appreciation potential, and it has tax benefits. But I do think that you lose a lot of the diversification benefits of that correlation when you do it through REITs. So there are definitely good examples of things to use. Me personally, I have direct real estate investments in my portfolio. Now that's through mostly residential real estates, long-term rentals, as long as one short-term rental. But I've allowed that to kind of replace not just the David Swensen portion that he has allocated to real estate, but also going into some of the percentage that's allocated towards bonds, because it has a lot of those same characteristics for me in terms of income generation. And I really do appreciate the low correlation to the stock market because real estate values, especially when you look at them on paper or Zillow or whoever you want to value those, do not change nearly as much as the stock market does. So when the stock market might be going down 30%, my real estate values, at least on paper, are showing the same, relative value, if not appreciating while the stock market's going down. So it's really a good diversification as well as a psychological benefit of investing in real estate.
Yeah, so many things you said there that I want to just touch on. So yeah, I'm not a big fan of publicly traded REITs for all the same reasons that you mentioned, the volatility, but especially the correlation with the stock market. There was a 20-year study by Morningstar that found, I think it was a 0.59 correlation with the US stock market at large, US REITs, which is on par with other sectors of the economy, like energy stocks, for example. So that just makes it one more sector of the stock market, basically, and defeats part of the purpose of investing in real estate, which is that diversification away from the stock market. So I love that you touched on bonds as well. So as an investor in my 40s and as a real estate guy, I fill the role of bonds in my portfolio with real estate. Now, I know that not everyone feels comfortable doing that. Not everyone has, the experience with real estate to feel comfortable doing that. And some people, people close to retirement or in retirement, maybe that's not appropriate for them. And I totally get that. But, to your point, real estate does offer a great hedge against inflation. And obviously bonds, people consider them low risk, but they are subject to inflation risk. So, bonds may have lower volatility and more likelihood of paying out, compared to stock investments. But, they do suffer other types of risk as well that a lot of people don't talk about. Real quick before we wrap up this little micro topic that we're doing right now, I'm just curious to hear any further thoughts that you have about, the risk of bonds versus real estate and how investors should think about, bonds versus real estate in their portfolio and whether it's worth replacing some or even all of their bond allocation with real estate.
Yeah, the big question that people have to ask themselves when they're replacing those two things is their liquidity needs, right? That's where
Right.
bonds, I think, provide some advantage over a lot of traditional real estate investing.
It's a great
But
point.
the risk, like you mentioned, for bonds is 100% true. In fact, I think it's one of the least talked about risks in all of investing is the investment in bond risk because you're still competing with inflation. And if you look over a 30-year time frame, because I've actually done this study looking at, fun, things like the price of a six pack over time, right? And you look at that over 30 years, and if you invested in like, treasuries or, like not junk bonds, let's just use treasuries as an example, you will underperform and you will see your purchasing power deteriorate over time. And that's even if you started out in the 70s when they were making 17%, right? Because eventually they've gone down and inflation has varied that entire time, and bond returns have not kept up with that inflation factor, which is where real estate has an amazing potential to keep up with that because you always have the income potential. So if inflation increases, then your rents can increase at the same time and your income goes up. So you're not just looking at the appreciation, which can vary based upon interest rates, but you also have the income appreciation, which will be met by market demands in an inflationary environment. So it's a real benefit if you can have that longer term liquidity.
Yeah, no, those are all great points. And, not only do rents rise with inflation, but they're one of the primary drivers of inflation. And, when you buy properties directly, you're buying in yesterday's dollars and locking in, that pricing, your mortgage payment gets fixed in that those dollars, even as your rent, rises. So that margin rises disproportionately faster than rents themselves rise, which, a lot of novice real estate investors don't fully appreciate that mismatch there. So,
Right.
Sean, I love it. In 30 seconds or less, how do you help people and how can people connect with you if they want to take you up on that help?
Yeah, so I'm a flat rate financial advisor. So I do financial planning, tax preparation, tax planning, and wealth management all for one flat rate. You can find me at purposebuiltfs.com. That's my main website. So that's PURPOSE F as in Frank, S as in Sean.com. That's the best way. You can also find me on social media, LinkedIn, Twitter. Just search my name. So I'm here to help out investors, and I really do have a slant towards real estate. So if that's something you want help with, I'm here to help.
Awesome. Well, Sean, thank you so much for joining us today. And guys, if you enjoy these quick hit conversations that we have, please rate, review the show. It makes a world of difference to us. And we will catch you on the flip side. Want the cash flow appreciation and tax benefits of real estate without becoming a landlord? You've heard of REITs and real estate crowdfunding, but you probably don't know much about 5 other ways to invest passively in real estate. So we put together a free video course for you to show you how to consistently earn 15% plus returns from 5 lesser known hands-off ways to invest in real estate. And even more importantly, we'll keep risk front and center in that whole discussion. Because really, what's the point of investing for high returns if you also take on high risk, right? So visit sparkrental.com/free to take our free course. Each video is snackable at 10 to 15 minutes long, and the entire course takes less time than watching a movie. Looking forward to chatting with you from within the course.